wave of bankruptcies around the globe seems getting closer and closer. That's the element, one of the theme element of our episode. Welcome to another dose of update on the market outlook from Blockrevision. Today about the spooky insights of economy and as well about FOMC minutes meeting that will just ahead. So without further ado, let's get into next episode. All right, let me find out at first whether everything works fine. You may write it down in the comment section below the video. All right, so I've noticed we are still in a I've switched to the full screen to make it more visible. So economy view is the first section that is kicking off our transmission. We are heading to Fed under stress. High interest rates hits Federal Reserve. So the budget deficit is likely to be around 5% of the GDP in 2023. That abject performance is often noticed when the economy is operating beyond full employment, where we have many headwinds around. So it's horrible jumping off point what lies ahead. Much higher debt service costs and soaring social security and mediocre spending as the baby boom generation retires. The squeeze on government finances will be exacerbated by a sharp rise in the cost of Fed's liabilities relative to the earnings the Fed realizes from its holdings. What I meant of the holdings, yeah, of course, about the Treasury and agency mortgage-backed securities. So the rise in short-term rates will cause the central bank's income to fall from a profit of more than 100 billion in 2021 and will end up to a loss to what's predicted to end up at 100 billion bucks in 2023. And those short interest rates are here to stay for longer, as inflation is unlikely to fade. What we had General Motors chief executive officer citation added, we're still seeing strong demand for our vehicles, but we are mindful because the steady rise of average transaction prices is starting to come back a little. So we can find that demand is eventually getting back. And also 2 years of semiconductor shortages and supply problems have kept vehicle production low, inventories lean. With factories picking up pace again, consumers will buy more vehicles this year, possibly, even if automakers have to help them manage rising interest rates by cutting today's lofty prices. So we are heading next. That was about US dollar. That's still having its dominant power in the on the world, in the market, where inflation couldn't really spook the outlook of it, but will be nagging Fed this year as well. So what about the euro? Euro USD currency pair is the most important market where the highest volume of transactions take place. That's why we need to know what about the euro. So recent ECB statement on December seemed blunt, and in the first quarter there are yet to deliver on the how the quantitative tightening may look like. But in terms of in terms of rates, everything seems clear now. They don't have the luxury to break something, as Europe is already in a real trouble. That looks like inflation in the area needs to stay for longer. Notwithstanding, we have an outlier voice, Martin Kazak's. In the next two meetings, I think we can still do quite large steps, he said Tuesday in a phone interview. And currently, what he says, he would like to see having the euro getting stronger during next two meetings in February and March. He expects bigger increases. So the question is, can ECB surprise us? Are they capable to tweak their narration even if if it may threat the stability of euro area and eventually take some more risky path? Recently, ECB took the deposit facility to 2%. The refinancing rate was at 2.5% and the marginal lending to 2.75. So policymakers right now said that rates are expected to rise far further due to a substantial upward revision to the inflation outlook. Inflation forecasts were revised higher, with average inflation seen reaching 8%, 8.5% in 2022, before decreasing 6.3% in 2023. So it's still very high. So ECB has much more to lose in terms of hiking interest rates in relation to Fed. Internal problems higher than ever, and it's it's all about the offset between two high interest rates that we find on a collision course with Italy economy and other very indebted countries, and low interest rates that may threaten Germany's stability. So it's not kind of a soft nut to crack. So let's head ahead. Let's head forward. The credit market in headache. So the market has balanced in recent years. There was around 834 billion of leveraged loan issuance in the US last year, more than double the rate in 2007 before the financial crisis hit. The strains are largely linked to aggressive rate increases by the Federal Reserve and central banks around the world, which have dramatically changed the landscape for lending, upended credit marks, pushed economies toward recessions, and it looks like that's a scenario that markets have yet to price in. So the cost of servicing debt is increasing significantly. Loan loss provisions at systemically important banks surged 75 in the third quarter compared with a year earlier. Clear indication that they are bracing to payment issues and defaults. We can find that industries with most distressed bounced loans as real estate. This is very difficult situation right now. Defaults in the air, we can find that companies are more leveraged than ever before. So average debt to EBITDA right now are at a very high stage, and it means that with high interest rates, it's getting more and more dreadful. Government bonds yields soared after the country's encosted mini budget in September. There, we can find there is a huge mark-to-market losses for pensions using so-called liability-driven investment strategies in UK. So the chaos meant the Bank of England that had to intervene to protect its financial stability. So we can find that indebtedness is something that is getting more and more difficult to sort out. The meltdown is a signal that governments and central banks will have to treat on fiscal issues with market sentiment so fragile. The underlying loans have higher leverage ratios and weaker covenants and then in the high yield market. So we have less concern that these defaults hit the safest trenches because they have over collateralization levels that are generally acceptable. So that's why we need to be very cautious in terms of betting on a long-term growth prospect.